Hello, everybody. Welcome to tonight's webinar. We are going to be spending some time talking about retirement accounts, but it is called Retirement 101, an overview of your options. I am Jenny Taylor, an investment advisory representative here at TRADEway. Joining me tonight is Pepper Posey, the executive director of TRADEway's AMPT department, and Ben Russell, otherwise known as the Superman of TRADEway. He is an investment advisory rep as well, but holds so many other titles as well. So thanks for joining me, Ben and Pepper.
It's great to be on with you tonight, Jenny. It's going to be exciting.
Yes. And just so everybody knows, I'd love to know where you're coming from in the United States here. I am up in Minnesota and we are surviving wildfire haze at the moment from Canada. And so pardon me if I end up having to cough a little bit during the webinar tonight. But if you could go ahead and use your chat for, we might ask you questions, use the chat box for that. But also if you do have questions, feel free to type those in the Q&A box. Sometimes they can get lost in the chat. So we just ask that you put the questions in the Q&A. We also have David Verbruggen, another investment advisory representative here at TRADEway with us, and he will be helping in the background, answering some questions. There he is. We'll probably, pose a couple questions to him at some point tonight too as well. And then Cassandra Russell is also helping us. She is a client engagement manager and helps in the AMPT department as well. So we are excited. This is more of an informational webinar about some retirement information that, a lot of us might be aware of already, but there is some maybe new information, and stuff is always changing with rules and regulations when it comes to the retirement accounts. So we want to spend some time talking about that tonight. So we want to highlight the different types of retirement accounts that are available, so that you can use this knowledge to evaluate which type of account is best for your retirement needs. And before we really kind of get into the different types of retirement accounts, I just want to encourage and remind you it's never too late to start saving for retirement. And I just want to encourage you to make that pay yourself first, right? Instead of, figuring out, oh, this much is left over, then I'll save this. It ends up being, oh, this much is left over. Oh, I'd really like to go buy this, right? So I would recommend you guys getting that in your budgets. Like, this is something I'm paying myself this amount every month. And whether that's, with your account that you might have with your employer, a retirement account you might have with your employer, or even just a savings account or a brokerage account. I just want to encourage you guys to save for retirement. But when it comes to retirement accounts, there's really kind of two broad umbrellas that they can fall under. The first one would be an employer-sponsored retirement account. And this would be, you work for a company that has retirement benefits, and then it would fall into a number of type of accounts that we'll go over a couple of those shortly. But the other major umbrella are going to be individual retirement accounts, which are self-directed. Whereas the employer-sponsored retirement accounts, they are being run by whoever the company has hired to run that plan. There's not as much flexibility. You might not be able to, choose what to have the money invested in, or if you do have choices, it might be very few. But the main types of employer-sponsored retirement accounts you're going to see are a 401k. That's at a for-profit company. 403bs are generally the type of retirement accounts you're going to see at nonprofit, either whether that's a company or a church. TSPs is short for thrift savings plans, which are the government employees generally have thrift savings plans. And then there are others, of course, but one major one is just pension plans, which end up being slightly different than the others that I've mentioned, because a pension plan is where you're going to be able to, when you get to retirement and you're retiring, you're going to have to decide, how are you taking that pension? Are you going to do a lump sum payment? Are you going to do monthly payments till you would pass away? Or is it going to actually go to you, but then pass on to a surviving spouse or surviving child? And that's something you have to actually talk with your benefits administrator about to determine, how you're going to take that pension. So the types of individual retirement accounts, though, everybody's probably heard of a traditional IRA. And a lot of people have heard of the Roth IRA, but one that's a little bit more less common is a SEP IRA. So we'll spend some time talking about those three as well. And there are a couple other options for retirement accounts, or there's also education savings accounts that they're different than retirement accounts, but they some of it, of course, has to be used for education. And but yeah, so there's lots of different options available. And with that said, there's so many different options available, we kind of need to learn, like, well, how does the structure of a retirement account work? So we're going to kind of cover first what that kind of looks like when it's an employer sponsored retirement accounts. So really any type of retirement account that you have, you're going to be funding, right, with money. It's either going to be pre-tax money or post-tax money. So what that means is if you're funding with pre-tax money, you haven't paid taxes on those that money yet. If you fund with post-tax money, you've actually paid taxes on that. And how that matters is when you're taking distributions. So I'm going to cover that part in a minute. One of the great things about employer-sponsored retirement accounts is that the employer will often match up to maybe 3 to 5% of your salary. Some could be higher than that. Some might not even do a matching program. All of that is just going to be dependent on the plan that your employer has. And the money that the employer does match in these cases, that would always be pre-tax money. So with that said, when you are funding retirement accounts with pre-tax funds, the government has a required minimum distribution age. Currently, as of 2023, that is 73 years old. So you have to start taking distributions at 73, whether or not you are retired. And why do we all know why the government wants that, right? They want to get taxes paid. So when you contribute pre-tax funds, it's actually tax deferred. So you're deferring your taxes to a later time. And that is why the government has this required minimum distribution. You have to take a certain amount. There are actually calculators out there you can Google that can help you see what the required minimum distribution would be for you if you are 73 and you need to determine that. Another person that can help you with that would be a CPA or a tax advisor as well. So when you contribute pre-tax money, okay, you are deferring the taxes to when you take out the distributions. If you contribute post-tax money, then you don't pay any more taxes because you've paid it up front. So those types of retirement accounts are called Roth. So ROTH, Roth retirement accounts. Even in an employer-sponsored retirement account, like a 401k, there could be a portion of that is Roth money. It's it's post-tax. You're not going to have to pay taxes on that or any gains that would have the potential to be earned in that. So that is kind of a good overview of what the employer-sponsored retirement accounts look like. But what about those of you that maybe work for an employer that doesn't offer retirement benefits, or maybe you're self-employed or you have a small business? There are options for you available. And these are going to be those individual retirement accounts where you're in charge of, you could be in charge of the investing, or you can, they're called self-directed, right? So you can determine who is going to be your advisor, or whether maybe you're going to be doing the investing yourself. The most common one that everybody probably knows about is going to be the traditional IRA. So the main thing about the traditional IRA is that we are going to be contributing pre-tax funds. Okay, so we will be deferring the taxes. In this case, it would actually lower our gross income for the year. So, that's one thing that you have to be aware of when you're contributing to IRAs. is what is the is there tax benefits? Is there tax consequences? So those are things you're going to have to meet with a CPA about, or a tax advisor. With the traditional IRA, there are max contribution limits. For the traditional IRA, it's $6,500 or $7,500 if you are 50 or older. And again, I already said it is tax deferred, so you will pay taxes upon distribution. And there is also penalties, and I don't have this anywhere on here, but I'll just mention it now. If you would withdraw funds, believe it's 59 and a half, before you are 59 and a half, then there's actually a penalty. I think it's a 10% penalty, in addition to your taxes. But Ben, if I have that wrong, you can jump in there.
Well, that's correct.
Okay.
It's a 10% penalty unless you fall into certain categories. So
Sure.
what might those categories be? Well, it's things like buying a first house, some sort of an extreme hardship that you can
Right.
get a waiver from the IRS. But typically that 10% penalty, they kind of want you to leave the money in.
Yeah. Yeah. And that's in addition to the tax bracket that you're going to be at. So, I mean, if you're in a 20% tax bracket or 15% tax bracket and you add the extra 10% on for that fee, or that penalty, it can add up.
So, Jenny,
So,
could I
yeah,
interject with a
please do.
question that's here in the chat?
Yep.
So we do have a chat question from Sarah. She's like, so how does my employer do it, right? If I'm a Roth contributor and all, how does my employer keep track of those different accounts? How does that work?
That's a good question. They have a bunch of accountants that do that. But they have hired somebody, an advisory firm, to manage the funds. And it's also, it should be showing up on your pay stub and things like that. But Ben, you may have a little better answer for that.
And what happens is that when you make a pre-tax contribution, it goes into your 401k, the normal IRA-like 401k, it's the pre-taxed account.
Yeah.
If you have a Roth 401k, you can elect to take a post-tax infusion of cash, right? So I can pay taxes on $100, right? So it shows up as income on my paycheck, but I deposit that $100 into my 401k Roth. I'm done paying taxes on it. I don't pay taxes on it again. What about the employer's match? Let's say they match, and we'll talk about matches in a bit. Where does the employer's match go? That goes into the pre-tax account. So I'll have two accounts of my 401k. A 401k Roth, that's the money I contribute. I've already paid taxes on it. The pre-tax 401k, the normal 401k account, well, that's where my employer's matching funds go because my employer's not paying taxes on those contributions.
Right. Yeah. Yeah. And it's and like you said, it has to specifically do with what are you designating it as, right? So when you go to do the contribution, you are having to select, is this like you said, is it pre-tax or post-tax, Roth contribution, or regular, like a regular IRA contribution, and then that's tracked. So then you have that information when you do your taxes for that year.
Very good.
Yes, thank you for that question. So just like with, a pre-tax 401k, let's say, contribution, there are required minimum distributions. It's going to be the same for any pre-tax IRA retirement account right now, again, that's 2023. For 2023, it's 73 years of age. Recently, can't remember which month, but the Congress did pass the Secure 2.0 Act, which increased this required minimum distribution age. A lot of people are working longer, whether that's because they have to or maybe they want to. When the required minimum distribution age was like 70 and a half, if you're still working and then you're also required to take those distributions on top of that, that could really maybe bump you up into a higher tax bracket. So them increasing this is probably beneficial. And by 2033, it's actually going to go up to 75 years of age for the required minimum distribution for your traditional IRA or the pre-tax funds on your employer-sponsored IRAs. And let's just cover this also here. When it comes to these individual retirement accounts, you can only fund it if you have earnings, like earned income, right? So you have to have earned income to be able to contribute to a traditional or Roth IRA. Now, in the case of where maybe one spouse is staying home, it's generally the mother that's staying home with young kids, taking care of kids. What's great is they actually allow and have it where the spouse can make the contributions for the spouse that is staying home and not working at that time due to taking care of kids. So that is, I think, a really great thing that they did for this, where women are able to still be saving for retirement, maybe even without having a salary during those years where they're doing something a little bit more important, right? Raising their young kids. But it does have to come from earned income to be able to contribute to an IRA. And the other type of IRA is a Roth IRA. So these are really a great account. I mean, I think we're so blessed. I think we're really blessed in America, and we don't really even realize it. But one of the great things, aside from the stock market and all the different products that are available to us in there that we can utilize to have the potential to make, trades and make money in the market, is they've created a Roth IRA, which you contribute post-tax money. So you've already paid taxes on, and any profits you would make in it are tax-free. And there's just so much opportunities with Roth IRAs. Especially with some of the, education that TRADEway offers of teaching you how to trade and how to invest. But the same type of max contribution limit is the same at $6,500, $7,500 if you're 50 or older. The main difference between the Roth and the traditional is that there are actual income eligibility restrictions. So if you make more than a certain amount, and this amount changes pretty much every year due to inflation and taxes, if they change the tax rates and such, they end up adjusting these income eligibility restrictions. But if you make more than a certain amount, then you actually can't contribute to a Roth. But if you, there are levels that if you make this amount, but not this amount, you can contribute this much. And again, since this is changing, we really recommend that you look up this information at irs.gov. And that's going to be the most current and up-to-date information on all of these rules, regulations of the max contribution, as well as these income eligibility restrictions. But one thing that I think is really great about this, and especially for young adults, but also, married couples that would then have kids and they're at home, and you have all these extra deductions in your taxes that you might not otherwise have once your kids are grown and out of your home. If you can contribute and max out your Roth while you have those deductions, then when you don't have those deductions anymore, your income, your federal tax, I can't even think right now, but your tax rate that you're taxed at may go up because you don't have all those deductions anymore. Well, then if you've been maxing out your Roth, then when you take the distributions, you don't have to pay taxes on those. So there's a lot of great opportunity available with funding Roths. We just have to make sure we fall within those limits that are there. So once again, you've got tax-free distributions. And what's great is because you've already paid your taxes up front, the government doesn't really care because you don't have to pay taxes when you take it out. So there is no required minimum distribution for this. If it's your own IRA, if you inherit it, then there will be required minimum distributions on that. Ben, anything else you want to add on the Roth here?
There's a few questions that are in the background that I think are really interesting. There's a comment made that a 403B Roth account, that there's still a required minimum distribution. And it's interesting to recognize that if you have a Roth and an employer sponsored account, then yeah, they're going to force you to take RMDs. But
I
if it's
think,
just a Roth IRA in your name, like you've already moved it out of your employer sponsor, and I think we'll talk a little bit more about that later on. But if it's no longer in an employer sponsored account and it's designated as a Roth IRA, as long as you're alive, you don't have to take money out of it. So your heirs will have RMDs
yeah.
associated with the Roth. But it's really interesting how many little nooks and
Mhm.
crannies there are in these little rules and the taxes and all the rest of it.
And I would actually maybe say you should look that up, because I think with the Secure 2.0 Act, I think in the next couple of years, that is actually changing about your 401k or 403 Roth. I think that it will be, I think that's coming off. I think I read that, but I don't know 100% sure. But I do think that the RMDs on those is actually getting removed from the rules, but it isn't yet. So we should look that up. And
And the other thing I would say is that if you ever have a question about your specific plan, call your benefits administrator.
right.
They are very up on all the rules for your specific plan. They can forward you all the appropriate documentation, and the 1-800 call my company line, whatever you want to call it. They've got people there that know exactly what's going on for your specific program. And Jenny, that's one of the things that I find really amazing. Is
Mhm.
any company's program the same as any other company's program?
No, I mean, what's crazy about it, it's however the company has decided to set up their retirement benefits. Do they have retirement benefits? If so, are they matching? Okay, up to what percent? Are they actually like giving kickback, like not kickbacks, but like, oh man, you've maxed out your contribution, we're going to actually, give you 5,000 more in yours. Like there's all different sorts of ways that they can do that, that none of them are the same. None of them are going to look exactly alike. And that's why you'll hear us say on like kind of repeatedly, you got to call those benefits administrators to find out exactly what you can and can't do, and to know exactly how that's working for you.
Now, there's a question here about, hey, I'm not yet 59 and a half. Can I take distributions from a Roth account and not pay the penalties?
Good.
I'm going to tell you the answer is generally no, but if you talk to a tax accountant, there is a loophole that they can help you to leverage. If you call yourself retired, you can actually start to take systematic withdrawals from your Roth IRA, but you want to do this with the help of your tax person.
Yep.
You can do systematic withdrawals and declare yourself officially retired for purposes of the IRS. And then you can begin to take systematic withdrawals from your Roth account. You can't, however, just take a $500 draw this month, 700 next month. If you're going to do that, work with your tax person, and they're going to force you to take a very consistent amount every single month.
Mm-hmm. Yep. Yes, that's great questions, guys. Please, if you have other questions, feel free to put them in there. There's so much information, and it's so different depending on, again, whether it's individual, employee, or sponsored. Again, where you guys are at with your tax brackets and all that. That's why it's best to really talk to a CPA, a tax advisor, about all these different.
We got a great question here. We've got lots of traders here. So is
Mhm.
money that I make from trading considered earned income?
In a Roth IRA?
It's not earned income. It's all about, that's capital gains. So that does not qualify as income from the perspective of money that you claim on your taxes as wages. So how do you maybe get around? Well, talk to some of the companies like Prime Corporate Services that help you to be able to create a business around how you trade, and then you can pay yourself a salary. Now, if you're trading your own corporate funds and paying yourself a salary, what does that money become? Yeah, it's income. And what does your company now have the capability of maybe being able to do? Oh, like maybe sponsor you for a retirement savings plan and help you with matching contributions. So if you really want to go down that route and you're doing great in your trading and you want to figure out how to be able to protect some of that income, it's exactly why we've got access to companies like Prime Corporate Services that help you to make trading into a business and help you to structure these things very differently.
Yes. Yes, but if you are doing the trading in your Roth, right? Then whatever profits you would have, it's not going to be taxed.
Right.
So that's
And
another
that was
reason,
specifically like, so if I make money
Yeah.
trading, can I
Okay.
use that money to contribute to my Roth? And the answer would be no, because it's not going to be treated as income to you.
Okay. All right. Sounds good. So now I have one that maybe not everybody has heard of. It's called a SEP IRA. And what it is a simplified employee pension IRA. So this is really for self-employed or small business owners. And the way that this there isn't a Roth option for this. This is all pre-tax money, so that it is tax deferred. But what is neat about this is this allows people to be able to save a lot more than what the max contribution limit is for a Roth and a traditional compared to this. Because you can see here, there's a max of 25% of salary per employee, right? So this is why it's so great for self-employed or maybe a doctor or a dentist, that, let's say you pay yourself $100,000 salary, and you can actually put $25,000 into a SEP IRA each year if you pay yourself $100,000 salary. But you do have to do it for all of your employees, whatever percentage, or with a max of 25% of the salary, you have to do it for every employee. So you couldn't be like, oh, me and my spouse, we're going to get 25% for our small business, but our other employees, we're only going to give 10%. It's got to be the same level. Or you can go up to $66,000, and that's for 2023. So you can see how, if you are a small business owner or you're self-employed and you have a higher salary, you can contribute a whole lot more than $6,500 or $7,500. So this is a great option for these self-employed or small business owners. Again, it's tax deferred. We're going to pay taxes at distribution, and these have the same required minimum distributions, 73 years in 2023. So that's really all we've got about the different types of accounts. But now it's like, well, man, okay, I learned all this. Okay, I'm getting retirement benefits from my employer. Could I still open a Roth or a traditional? And then how do I decide what to do, right? How do I decide which one to do? So we're going to have Pepper come and actually talk about a little bit of a comparison between traditional IRA versus a Roth IRA. So welcome, Pepper.
Great. Thank you, Jenny. Yeah. And of course, I'm sure y'all are wondering, well, which one is right for me? Is the Roth better? Is the traditional IRA better? So anyway, that's what we want to talk about. So what I want to show here is what the expected difference would be in outcomes, whether you're invested in the traditional IRA or a Roth IRA. In order to do that, we've got to make at least some assumptions. So I can make a reasonable comparison between them. So just wanted to let you know what my assumptions are. One would be that the tax rate for a person remains 20% throughout their earning career and into their retirement years. The next one would be that the rate of the return for the retirement funds throughout the 30-year career and really even into the retirement years remains about 8% per year, which is about what the historical average for the S&P is. The third one is that the clients will withdraw funds at a 5% yearly increase each year so that they can stay up with inflation that may be occurring. And I have not included anything as far as sources of other income, such as Social Security, maybe your stock market trading, investments, any property rentals, any other source that you might have. I'm not going to include in here. So for this one, for a Roth IRA. So I'm just, again, these are just for comparison purposes. So in this example, I am making the assumption that someone is placing $200 a month or $2,400 a year in their after-tax Roth IRA account. And again, they're going to get an 8% yearly growth on it. So they do that for 30 years. And then beginning at retirement age of 69, This person has accumulated about $300,000 in their account. And then they begin withdrawing $24,000, so $2,000 a month, $24,000 a year, the first year. And then each year after that, again, they're going to increase that 5% because they need that additional 5% to keep up with inflation. So they'll begin that in their second year. So in this example, at year 15, when the client is 83 years old, there's only about $7,100 left in this account. So it's about two more months of distribution and all the funds are gone. So again, so year 15, client 83 years old, all the funds are gone. Okay, let's go to the next slide. Jenny?
Yep.
All right.
Sorry,
So-
I was doing some drawings to try to have people follow along. So here, let me
Okay.
go to the next slide. Here you go.
Okay, so here's the graph and the information for a traditional IRA. Now, so that I can make actually a legitimate comparison, the person in this example is going to be investing $250 per month instead of $200. So $3,000 a year, but again, this is in their pre-tax traditional IRA account. So $50 a month more, so therefore $600 a year. But this really makes it fair because that person is not going to be taxed on that $3,000 that they put in on that first year because they have a 20% tax rate. So their take-home pay would be exactly the same, but they're putting $250 a month in instead of $200. So also, since we're going to make it comparable to the Roth person taking out $24,000 a year, this person has to take out $30,000 a year. So again, because they're having to pay taxes on it at 20%. At the Roth, the person that had the Roth IRA had about $300,000 at retirement. The person with the traditional IRA has about $372,000 in their account. And guess what? At year 15, when the client's 83 years old, she or he would have about $1,200 remaining in the account. Okay, wow. So let's look at slide 3 then, Jenny.
Yep.
So over this comparison that we're taking a look at, so it's a 30-year career, a 15-year retirement period, and they're both pretty much actually out of funds, right? At year 15. So yeah, there was a little bit a difference of $5,900, but over that period of time, that's pretty insignificant over this 45-year period. So now your question, of course, is, well, does it really matter whether I choose a traditional IRA or a Roth IRA? And the answer to that is, well, maybe so. And the reason for that would be, it depends on what your taxable income is when you're making your contributions. So if you just, for instance, for this year, for 2023, if you have a taxable income, if you're a single person and have $45,000 or less, or if you're a married couple and have $90,000 or less, you're in the 12% tax bracket. If you expect your retirement taxable income to be higher than 12%, then a Roth IRA appears to be the better idea, at least for the present time. So later on in your career, let's say if your taxable income now increases again from a single person over that 45,000, again, I'm using 2023 data, or going all the way up to 182,000, or if you're a married couple, if it's over $90,000 all the way up to $364,000, your tax bracket is now either 22 or 24%. So if you expect your retirement income to be less than it would be otherwise, then a traditional IRA would appear to be the better idea. So again, you would be expecting your retirement income to be less than 45,000 if you're single, or less than 90,000. So then it would make sense to say, hey, I want to do the traditional IRA because my tax rate is going to be lower when I retire. Now, the good thing here is you can contribute to a Roth account in your lower income years, and you can switch to a traditional IRA in your higher income years. So why not take advantage of choosing the best one for your current income level? And again, what you suspect your retirement in your retirement years, what your expected tax rate would be then. So when you do that, you're going to make the best choices for your retirement years.
I do have one thing that what you said made me think of something. So I also just want to make everybody know that if you are going to contribute to both a traditional and a Roth in the same year, you can only go a total of 6,500 if you're under 50, or total of 7,500 if you're 50 and older. So you could put like 3,000 in a Roth and then 3,500 in a traditional, but you can't be putting like 6,500 in the traditional and 6,500 in the Roth. It's a total of 6,500 combined between these IRAs.
Yeah, and you know, in at least corporate employers, you can actually, for if it's just a regular traditional, again, not an IRA, but a 401k, you can go up to like 20%.
It's a lot more.
Total.
Yeah.
Yes, you can do a lot more there.
Yeah.
So guess what? So anyway, so there's the examples that you
Yes.
take a look at there. So traditional IRA, Roth IRA, if everything remains the same, it's not a lot of difference between the two.
Yes.
Okay, now I want to look at one more slide, and
Yep.
let's look at now one. Well, what if I have a 401k and I have employer matching funds? So let's take a look at that. So again, you know, Jenny mentioned, you know, it's 3 to 5%. Sometimes it's even more. And if you're in that situation, it is greatly to your advantage to contribute at least the whatever is necessary in order to match or to get to that matching amount. So here we go on this slide again. I'm gonna compare this to the traditional 401k. Traditional IRA. So the client still deposits their $250 a month in pre-tax funds. The company now is contributing an additional $125 a month. So the client still is going to withdraw their $30,000, and again, increasing that year by year by another 5%. And now take a look. The investor is now 93 years and 11 months old before their account is depleted. So that provides almost 11 additional years of retirement of funds. Now, okay, if you don't have an employer who provides matching funds, guess what? You can increase your contributions by another $125 a month and achieve the same outcome. But that really just shows you the advantage of putting more money in. In this case, the employer puts it in for you. And you're not going to get taxed on that until you start withdrawing the money. Now, before closing out my portion of tonight's presentation, there's two more points I want to make. Again, we're doing a comparison, so I contributed into these funds the same amount per month, per year throughout the whole 30 years. Realistically, throughout your career, hopefully your income rises. So if it does, it would be a great idea, of course, to increase your retirement contributions. So taking a look at what we were looking at earlier about the traditional IRA, if you just increase your monthly deposits by $25 each year, so $250 a month the first year, $275 a month the second year, $300 a month, et cetera, et cetera. Instead of your retirement fund being, again, comparing to the traditional, instead of it being $372,000 when you retire, you have about $704,000 just by another $25 a month each year throughout your career. That's an 89% increase in your nest egg. So think about that. Finally, I want to suggest that you get a retirement calculator similar to the one shown here. Determine when you plan on retiring, how much money you would like to receive from your retirement account, and then see if your current contributions are going to meet those plans. Now, again, I didn't include Social Security payments, other sources of income, but when you have a retirement calculator, you can put those numbers in too, to take a look at everything that's going to be going on during your retirement years. They also make it very, very clear, very, very easy to make adjustments. So if you say, gee, this is not working out, well, okay, let's see what happens if you add more money to your contribution rate. What if you change your retirement distribution? What if you, instead of say retiring at 69, I retire at 59 or 73? What, if your account growths, go up or down, you can change them. And of course, as you look at your tax rates, if you think it's going to go down, good luck with that. But if you think it's going to go down, you can make changes in that also. But anyway, this really enables you to make some informed decisions for your eventual retirement. Final comment on that: update your plans yearly with any significant changes, your changes in your income, your changes. If there could be health changes that may affect your retirement years. Whatever it is, you can use those to do what ifs in order to see what a good plan is for you and when a good time would be to retire. Now, lastly, TRADEway, we do not endorse, we don't suggest any particular retirement calculator, nor do we show clients how to use them. In fact, I personally made my own using Excel, but the one I showed you tonight has better graphics because mine doesn't have any graphics. And I think Ben or Jenny has already put that link into the chat window. But that's for that one. There are numerous other retirement calculators on the internet. So again, I think that would be a great idea for you to take those and work with them. Don't wait till you retire. Start now and start taking a look at what should I be contributing in order to get to the amount of funds that I want to be there at the age I want to retire. So Jenny, that is all I have for my portion. So I'll turn it back over to you.
Well, thank you, Pepper. I think that's really great information for all of us to take a look at and start playing with some retirement savings calculators. So, but again, yes, I think Ben put it in the chat. So we just have a few more slides, I believe, to go through. So what are your options, now that you learned all this information? So Ben, did you want to come in here?
Yeah, absolutely. So friends, what's happening here is it's a great opportunity for us to start thinking about, so what? I mean, what do we do now? We've talked about the programs, but how do we start to potentially use them, right? So we highly recommend that you think about the amount of money that your employer is going to give you as a part of the retirement savings program. Now I say give, it's really not a gift. It's a part of your employment benefit. So max out that employment benefit. Ask your benefits administrator, how much does my employer match? And every company is going to have a different answer. So I've worked for several different companies in my lifetime, and every company has had a different amount of money that they matched. Some match dollar for dollar up to a certain level. Some match 50 cents on the dollar. Whatever your company is willing to match for you, take advantage of that. That's free investment capital for you in your account. So we definitely want to make sure that you're taking maximum advantage of it. And that really begins to add up over time. All right, Jenny, next one. So you're going to fund a traditional or a Roth. Now, as Pepper just described to you, there are advantages that, you can kind of look at on both sides of that. When you're in your prime income earning years at a higher tax bracket, you may not want to put as much money into a Roth. And at some point in the future, we've talked a little bit about it in the chat, you can always do the conversion between a traditional IRA to a Roth IRA. What's the catch? If I convert from a traditional IRA, what do you think the IRS is going to want me to do? If I convert from a pre-taxed IRA to a Roth IRA, what do you think Uncle Sam's going to do to that account? You got a tax bill due. So whatever your tax rate is for that conversion, so if you convert $50,000, they're going to want you to come up with $50,000. Now here's where it gets interesting. Where are you going to come up with the taxes on $50,000? Well, I'll just take it out of my retirement account. No, can't do that, because that would be a distribution. So distributions, that would be money the IRS wants you to pay taxes on and a 10% penalty. So here's what some people have been known to do. You know what? I'm going to do the math. I'm going to do the conversion, and then I'm going to take a distribution of amount that I need to pay my taxes, and I'm willing to pay the 10% penalty on it. There's always ways around it. Just talk to your tax person. They can help you with it. All right, next one, Jenny.
One more thing I was going to say here too is, even if you are, your employer is matching your contributions, if you have the skill sets to be able to maybe invest or trade yourself, you may want to consider like funding a traditional or Roth IRA if you are within the income restrictions and max contributions limits. And that's where you'd talk to your tax advisor about it. But going over what your employer is matching, especially because you may not have any control over what investments they are doing. And like being with TRADEway, you're learning to do some trading yourself or investing yourself. It may be worth considering if you have extra that you can save from your salary to fund your own self-directed IRA or Roth IRA, or maybe you can just put it in a brokerage account.
So there's a follow-up question from Emily. Am I saying that there's a 10% fee for the conversion? No, it's not a fee to convert. It's a 10% penalty if you choose to take money out of the account to use it for something other than retirement. So when you take money out of a retirement account early, there's a 10% penalty. So let's say you wanted to convert money from a traditional account, a traditional pre-tax IRA, and you wanted to convert it to a Roth. How are you going to come up with the money to pay the taxes? Well, some people will take a distribution, pay the 10% penalty on that amount of money, and then they use that money to pay the taxes. That's one way that some people have been able to do it. But Jenny, you're right in the comment that you made. Can I just underscore that?
Yes, please.
Why would you put more money than what your company matches into your 401k? Especially when your 401k providers are very limited in what they allow you to invest in. All right, so you've got some skill sets. You're a part of the TRADEway organization. What if instead you put those contributions into an IRA that you manage or that someone else manages for you? Who might that someone else be? We'll think about that. Maybe the next slide might give us some clues. All right, Jenny, talk to a tax advisor to be able to get those maximum benefits. As Pepper was calling out, there are times in which you may want to actually contribute to a pre-tax IRA in your high earning years, and times in which it might be advantaged to you to be able to put them into a Roth and pay the taxes today. Now, something Pepper didn't mention that I think is really, it's kind of another part of the decision-making factor. Can you afford to pay the taxes better now or when you're retired? That's going to be something you'll need to think about. If you're like, I really want to prepay the tax bill so that I don't have to worry about it. There's some people that choose that because they don't want to have to deal with the taxes in their retirement years. They would prefer to deal with the taxes in their earning years. That's a personal preference. All right, next one.
That's great.
So this one's an interesting question. We get this all the time. Hey, I've got this 401k, and in fact, it's a lot of money. It's probably my largest asset, and I'm a little concerned about it. So I'd like to manage it myself. When I roll it over to an IRA, and the answer is maybe. Yeah. Honestly, it doesn't. There is no consistency here. Every company has their own rules. So what do? Call 1-800-MY-BENEFITS-ADMINISTRATOR. Hello, my benefits administrator. I would like to roll over. And that's the term, by the way. Write that one down. If this is you and you're like, what do? Write this question down. Benefits administrator. how much can I roll over from my 401k to an IRA, a self-directed IRA? They're going to tell you the number. Go ahead, Jenny. I'm sorry, I thought you were
Oh,
saying
no,
something.
I cleared my throat.
I apologize.
The haze. Just kidding.
Yeah, it's that haze. I hope it goes away soon. All right, so that old 401k rollover is definitely one that you want to think about. And especially if you have older 401ks just hanging around from some old companies, I think about that. Are they really going to be able to help manage those funds? And you're at TRADEway, you recognize that the market doesn't always go up. So how do you protect those funds? Very limited choices in what you can invest inside of 401k. Next one there, Jenny.
I think that might be it.
That's it. All right. Well, it is not the end, because what
Oh.
we've got is the next part of what we would like to talk about. All right. So here's what's going to happen is we've got David Verbugen, myself, Jenny Taylor. We are investment advisory representatives with this company called TRADEway, the company that's sponsoring our webinar today. And what we do as IARs is we assist people like you with the very things that we're describing today. And what happens is that we're willing to get on the phone with you, talk about your specific situation. So the other option that I like to be able to present in the Retirement 101, an overview of your options, is guess what? You've got the option of getting our help. Our help. And the program that we have is called Assisted Managed Portfolios by TRADEway. We affectionately call it AMPT. AMPT. So when you see David, Jenny, or myself, you'll see that AMPT is a big part of the job roles that we do. And we meet people just like you every single day. And what we do is we help you to make the decisions about how can you help protect your nest eggs? What can I do with my 401k? How might I be able to better leverage my retirement savings? That's one of the major things that Jenny, David, and myself get to do every day. So we're here to help you with it. Now, why do we do it? Well, because what happens is that unfortunately, when you are with a traditional money manager or maybe an investment advisor that doesn't think like a trader, Jenny, you and I, we'd be at a seminar and somebody would walk up with this sheepish look on their face and they would hand us an investment statement and we would look and we're saying, wow, you held a $300 stock all the way down to $5.
Yes.
And unfortunately, go ahead, Jenny.
I was just say that was tough because that was before we had before David had created AMPT, and that is really why he ended up creating this department in TRADEway, is he wanted to be able to help manage people's long-term assets.
And unfortunately, and David Verbugen, you probably have some stories too. Have you kind of heard stories of people that are coming into our program where, their traditional financial advisor didn't do so well with managing their money?
Oh, absolutely. It happens all the time. It happened just the other day, and they're like, well, last year, I lost 20 or 30%. I'm like, oh my goodness, it doesn't have to be that way. It just doesn't have to be that way. So it is kind of heartbreaking, especially when you find out that, hey, they have a larger account. And so even last year, which for some of us, we think that's kind of the tip of the iceberg of what might come. Last year, some of them lost 6 figures. I'm like, oh my goodness. Well, what if this is just the tip of the iceberg, what is it going to end up being?
Yeah.
Well, they're not unique. They're not alone, because this pervasive mentality, look at this. US pensions lose $1 trillion. Largest, richest people on the planet lost $1 trillion. Here's a headline from CNBC 2008. Nearly 20% down in 2022. And what we're trying to do is this slide, this next one, tells the story of what we want you to recognize. This slide, it's a bit of an eye chart, but let me explain it to you. These are the bear markets through history. So through history, what you will see is that down at the bottom is the date, right? So here's the dates of all the very bear market crashes. This blue bar, this light blue bar, is how far they gone down. The dark blue is how many months did it take to go down. And then here's a really important number. You see this gold color? I like to say the gold is how many months did it take for you to get back your gold, your money. Okay, so let's go look at 2007. 2007, for 17 months, the market declined. And by the bottom of the bear market, it was a 56% decline. Now, I work at TRADEway. The name of our company says it. We think like traders. We think there's a different way. At what point during 17 months of decline do you think maybe you might have gotten the idea you needed to do something different? All right, so 17 months of decline, 56% decline. Then look at how many months it took to get back to even. Now, I'm not a math genius, but if I do 17 and 49, that comes out to what, 66 months? That's 66 months of decline and then get back to even. That's 66 months of my life from an investment perspective evaporated, and that doesn't even account for inflation. That doesn't sound like a good idea to me. That doesn't sound like buy and hold is in the best interest of us. All right, so here's the interesting part of it is that your financial advisor doesn't tell you those 50% declines. If you have a 50% decline, you got to go double your money to get back to even. Think about that for just a moment. How different might your portfolio look if you didn't take the 56% hit and now had more money for when the next bull market hits? Wow. So that's the thesis we really want you to think through. And what about this current market? Well, David Mitchell, other very senior investors, I often like to say the color of their hair may be a little different than some of us, right? They've got a little bit more of the wisdom that God puts on individuals as they age. And they're saying it's not done. When you look at the various things in the economy, David Mitchell, other investment advisors that have been around the block and aren't just used to just bull, they're like, this is probably going to get nasty and it's going to really hurt a lot of people. So we're trying to make sure that it doesn't have to be one of you. And David is monitoring some very serious potential systemic issues. And when you see that term systemic, that's system-wide issues that can affect the entire economy. And there's more than one on the radar that he's tracking. All right, so let's talk about 2022. Do we have a bar for 2022? We went through a bear market. Do we have a bar for it? Well, it went down 27%. So that's the bear market of 2022. But David doesn't think it's done. David doesn't think it's done. And on average, when there's this thing called a recession, which we haven't yet hit, when there is a recession, bear markets on average are 34% declines. There's a bar for 34%. So what's it going to be? Are we done going down? We just went down 27%. Are we going to hit a recession and we're going to see the average 34% decline, which means we're going down further than the October lows? Or are we going to see a systemic issue related to the various things that are facing our economy and that David is tracking that could take us even lower, like what we saw in 2008? We don't know yet. But what we do know is that we're going to be prepared and protective of accounts while we're in this unknown period for the market to try to have as much capital as possible ready for the time when your neighbor is getting back to even. We want you to have more of your capital so that when your neighbor's getting back to even, you're getting hit. That's our thesis in a nutshell. All right, so what are we watching? What's David and the team looking for? Inflation, banking system problems. There's just been a few banking issues, right? Just a few banks failing, a few billion here, a few trillion there. We're probably not done. 10-year treasury yields. This is a big one, friends. If you've never seen this before, this is what we call the inverted yield curve. And it is one of the most powerful and the most recognized signs of an oncoming recession. This is when you can get paid more money. And take a look. This is from 418, right? I just didn't update the slide. It's close enough. 3 months, you're getting paid 5%. So if you go get a treasury rate for 3 months, you're getting paid 5%. But the government is kind enough to only pay you 4% if you go out and you commit to them for 2 years. How does that make any sense? It doesn't. That doesn't make economic sense. And Jenny, how long has it been this way?
So it's been consecutively inverted since July 22. So we're going on 10, 11 months. So once we get to July of this year, that will be 12 months. And generally within 9 to 12 months, sometimes longer, is when you'll start you start seeing the signs of recession. So just in some reading I've done, they're like, it could start, they think, due to the yield inversion, that, Q3, Q4 of 23, but certainly by 24, they're thinking we're gonna, be in a recession.
Okay, and recession is great for stocks, right? I mean, that's just beautiful. That's an incredible environment for us to all be fully invested. We should just follow the buy and holders advice. We should just like pile into the stock market because, we make lots of great money in the recession, right?
Yeah, sure. No, we'll likely see a further legs down in the market, and maybe even new lows. Until we maybe see the recession, the market may go up and kind of down and kind of roll around sideways, kind of like what we've been seeing as of late. But we are still very concerned that we haven't seen the end of the bear market.
So let's look at some of the other things that David is looking at. So he's looking at the forward view of the stock market, the possible expansion and or end of that Russian war. China should be added to that list. Oil prices, systemic problems related to junk bonds. This is kind of interesting. Maybe it's difficult to understand this one, but there is an issue where a bond is a promise to pay. Is it a guarantee to pay? No, it is not. And if someone doesn't pay their bond, that's money that's lost. And in fact, in one of the most recent bank failures, there were billions of dollars just written off the books for debts related to a bond that were not paid. If we start seeing more bond defaults, if we start seeing more commercial real estate issues where people can't get loans to refinance their commercial real estate, there's a lot of these things that are starting to show cracks in the economy because of how far and how fast rates have increased by the Fed. And there's a lot of speculation about whether or not they're actually done. In fact, I heard from several Fed members just this week that said, job's not done. You should not be expecting us to cut because the numbers are still really hot. This is getting dicey, friends. And we're right at the timeline where that 9 to 12 month time frame for that inverted yield curve, it's starting to come to play. And if we do go into a recession, that is not good for equities. Regulation of crypto, that would be another thing. And this thing called CBDCs, that's central bank digital currencies. We don't yet know how that's going to play out, but it's probably going to have a pretty big impact on the economy when it does. We'll be watching it. All right, so how did the team do for 2022? David, you just mentioned this a second ago. You had a client recently come in and they lost how much? Well, they were probably invested in NASDAQ, right? How much did they lose?
Well, it depends on which client you're talking about, Ben. But yeah, I've had some with about 20%, some closer to 30% down. That was last year alone. So we're not even talking about some of the previous recessions that have happened as well. But yeah.
Well, it's interesting because look at the screen. So the S&P 500 was down 19. So if you're invested in something that's, like the S&P, 19%, tech heavy NASDAQ down 32%. That's a big number. That makes me shudder. What about the AMP team? How did we do during a very difficult time where there was an awful lot of very difficult conditions in last year's market? Well, we did lose money. Our most aggressive account lost 1.74%. So it's not like we did not knock it out of the park last year. But maybe when I look at 32% versus 1.7, that's pretty good. That's more than a base hit. Can we put some numbers on this? Can we maybe take these numbers and make them a little more practical? Let's look at a $100,000 account. So how would the impact of a $100,000 account for 2022, how would that have played out? Well, if you would add a $100,000 account at the beginning of 22, at the end, if you were in a NASDAQ similar, like some of the clients David was talking about, their accounts are now $67,000. Not 100, 67,000. Ouch. Similar to the S&P, you now have an $80,000 account. And our AMP clients, we did lose money. We're now looking at a $98,000 account. So that's just a way for you to be able to sort of see the impact of those numbers. And the program that we're trying to provide you gives you the opportunity to start thinking differently. We genuinely believe that avoiding these big declines is one of the keys to generational wealth.
Hey, Ben,
generational wealth.
Sorry, one more thing I wanted to say on that. Those were after our management fees as well. So I just
Oh,
point that out.
that's a great point. Great point. So that was after fees. So let's talk about generational wealth. How might this change the picture for you and your family if these, let's just round it up to 28. This is David Mitchell, by the way. If you haven't met him, that's a picture of David Mitchell, our CEO at TRADEway. He's like, I want you to start thinking beyond just your lifetime. I want you to start thinking beyond just you, because it's about you and your children's children, because that's what we are called to do, is to leave an inheritance for our children's children. So David's like, let's take 3 generations. We're just going to round that to 90 years. I think he's being kind there. I think it's probably going to be longer than 90 years, but anyway, we'll keep the number smaller. How many bear markets might you go through in a 90-year period? David's like, on average, they happen on 4 years. So you're looking at 22 and a half bear markets, 22.5 with the negative 28 hit, just round numbers. I can't really calculate that, Jenny. I'm not very good at math, but that sounds like a big number to me.
Yeah, and then if you even take into account, if I think you were talking about like compounding and all that. I mean, can we really lose 600%? But this is about 600 some odd percent that you'd be losing. But if we're avoiding some of these drops, or even half these drops, just what could that do to just a one family's generational wealth? And that's really why we believe cash is a position, not constantly being invested in the market, selling out of some bullish positions if everything is just getting drugged down. When you're out on a cruise ship, it moves up and down with the waves. And that's what all these great stocks, they get pulled down, but then that's kind of when, if they're great stocks, right, great growth stocks that get pulled down with a bear market, then it's going to be a great time to go jump in them. Once you see them bottom out and start, moving back up. So we really, this is just the whole reason why David wanted to create this amped portfolio for long-term funds, is to avoid these massive drops, to then give the potential to be invested when it makes sense to be invested in bullish positions.
So when your neighbor's getting back to even, you've been on the sidelines waiting for the right time. What kind of a difference could that make generationally? That is the vision we're trying to paint with the amped program. All right, so probability math, trading skills, market tone, knowledge of the markets, it's what we share with clients just like you. It's the question we ask, is how different could your portfolio look with this kind of an approach? And while we cannot tell the future, God did place probability math into the markets, and that's what we use with making our buy and sell decisions. And we look at larger time frame charts to be able to make those decisions. And the reason why we do it, and we don't understand why others don't, is because we don't want this to be you. When you start seeing these headlines about the massive declines in the market, Jenny, can you put up poll number 1 for me? I want to ask our friends, have they ever asked their financial advisor to take their portfolio to cash? Have you ever asked a financial advisor, take me to cash? I need to avoid this big downturn. I'm wondering. Find that chat box for me. There's a couple of options there. If you're currently an amped TRADEway person, you've already got an advisor taking you to cash. That second answer, Jenny, we often get that. My advisor talked me out of it. Oh, in fact, let me tell you that I actually had this happen this week. One of my new AMP clients, he was positioning his money. He was going to go to cash just before he moved it. And financial advisor says, you're not my client anymore. You're going to cash. I don't want you as a client. Wow. Now, I think it's a little revealing. Why is it that a financial advisor doesn't want you to go to cash? Might it affect their paycheck? The answer is yes. So think about that. There's always a background reason in mind there, right? So it's not just that simplistic, but you do have to ask why people do what they do. Oh, look at that next one. They argued and I made them do it anyway. That's a good TRADEway answer. I've never asked my financial advisor to go to cash. Jenny, that one, I look at that one and I'm like, oh, TRADEway students, we know better, right? But maybe before TRADEway, you didn't know better. You didn't know that you could ask and engage with your financial advisor to help protect your portfolio. And then the last answer, this one hurts my heart. No, I don't have a financial advisor. So why is David Mitchell and the team creating the groupings that we've got? Because we want to try to get financial help to people just like you. We're trying to make it to where more people have access to be able to help protect what God's given them. That's what we try to do. All right, so great. Thank you for answering that poll. You can see that not a lot of people understood that they could go to cash or even had the ability or the access to do it. So that's another reason why we created our program.
Yep.
All right, so let's continue on here. How do we do what we do? Well, we go to the Bible and we look at what the Bible says, and we're going to diversify because that's what it tells us in Ecclesiastes, and it actually defines groups to diversify in Ecclesiastes. We're going to get some subdivisions of the economy out of Ezekiel. This one's crazy. When you read that, you're like, wow, those are like things that I know and I can see today in my modern economy, and it's straight from Scripture. And it's actually how God gave David Mitchell the idea of creating AMPT in the first place. Now, it doesn't happen just with biblical knowledge. There's some technology involved to be able to accelerate the implementation of that knowledge, and it's Interactive Brokers. You may have never heard of them. Interactive Brokers works with people like Jenny and I. We're the investment advisors. They're really not as interested in retail clients, people that aren't part of an investment program. So they're not really looking for just individual traders. They want the investment advisors, people like us. And Jenny, they give us some amazing tools. With just a few clicks of the mouse, we can actually say, hey, let's go get everyone bullish, and here's the portfolio management by 5% of this, 10% of that, 6%. Just a few clicks of the mouse. And Jenny, it's kind of interesting when you start moving millions of dollars into the market with just a few clicks, huh?
Yeah, it is. I mean, we could potentially get into 25 different instruments in a matter of like 30 to 45 seconds. Like it's very, really great technology. 10 years ago, we wouldn't even have been able to do this. Because what's great is each person that, becomes an AMPT client gets to have their own individual accounts. You're not pooling money into some fund or anything like that. It's in your own account, and we create the groups that they go in, and then we're trading the groups, which trades individually in each of your accounts or invest in each of your individual accounts. So it's a really, really great platform that we use.
It's really cool how it works. Now, I see a couple of names here. So David, can I ask you a question? I see aggressive bull. I think I know what that is. We're just buying into stock positions, but wow, there's this thing here that says inverse ETF bear. What in the world are we talking about?
Yeah, absolutely, Ben. Guys, the bull, like Ben mentioned, we can make money on the way up. Of course, you can make money on the way up, but you can make money on the way down too. And it's not just with options that you can do that. There's these instruments called inverse ETFs. So when the market's going down, you can actually be making money. We actually did this during COVID. During COVID, some of our clients actually made money on that. The COVID crash I'm talking about, it lasted 1 month in the market. Some people made money on that using these inverse ETFs. So it's pretty cool if you know how to use them and when to use them.
So if you have an investment advisor that thinks like a trader, you have an investment advisor that starts to find some interesting ways to try to make money, because we understand markets go up and markets go down. Well, that's TRADEway. And we believe that cash is a position. And here's one of the main reasons why, because Interactive Brokers pay some of the best rates in the business. So when your money is not invested in the market and we're being more conservative, they're paying you 4.58% to be sitting in their money market account on anything that's over a $10,000 balance. That is really amazing. Now, I'm looking at what's going on in the economy. I'm looking at all the various things that are happening. I'm like, wow, why aren't more people doing this? And here's the interesting secret. More people are. More people are. They are starting to take their money out of the equities, starting to take their money out of what they feel to be an extended market. And the institutions are getting very defensive in their positioning. It'll be interesting to see how this one plays out. Remember what we said about that recessionary indicator? We're not the only ones that know about it. There's a lot of really large institutions that are getting defensive. They're putting their money in places just like this. Well, why not you? Why wouldn't you take advantage? Oh, because you didn't know about it. Well, now you do. Let us help you with it. What are some of the other things you happen to get apart when you join AMPT? Well, what about an investment advisor, Jenny, myself, telling you what we're doing and why we're doing it and what we see happening in the market? Well, so you're going to get those AMPT assist alerts if you join our program. We're going to tell you why we're making the changes that we're making. All right, we're almost done here, Jenny. So let's talk a little bit about this. There's a couple of ways in which our friends can help, and I'm going to ask you all some leading questions. The pro, David, would you just sort of tell me what is the pro program? Why do we have the pro?
Yeah, the pro program is where you push the buttons, right? This could be a good program if you want to be more active, more involved. You got to be able to react though, right? When we send that email saying, hey, it's time to get in the market, or hey, we need to go to cash now, then you need to be able to react, get on your computer, log in, do all the appropriate actions to get yourself in or out of the market. That's the pro program. You're pushing the buttons.
All right, so pro, our clients press the buttons. We're helping them, right? We're sending them a text, go take action. Here's the technology. You go do it. It's like we're teaching you to be the professional here. We're giving you access to our tools. We're training you. We're showing you how to do it. Now, Jenny, does that work for everybody?
For the majority of people, it really doesn't. And one of the things that I like to let people know is, man, if you are already very active with your own trading and you've been trading for 3 to 5 to 10 years, you're following the market, you know what's up, like pro is really probably for you. But AIM is probably for pretty much everybody else, whether you are new in your career, you are a government employee, a doctor, maybe you are a homeschool parent. It's very difficult to constantly be available whenever the market is open the entire year, to be able to take action immediately based on our email and text. And that is actually, we originally started with just pro, and we came to realize that we've got to be able to provide this as a service for people to do for them.
And it's pretty amazing. So that program, AIM, Advanced Investment Management, well, we're doing the work for you. Our team is pressing the buttons. And what you will see is that when we do the work for you, your startup fees are small because we don't have to train you. But the fees that you pay us to help manage are going to be slightly higher than if you're doing the work. So that's really how this program functions. Our long-term management fees are going to be a little lower if you do the work, a little higher if we do the work. Your startup costs will be higher if we have to teach you how. Your startup costs are lower if we're the ones pressing the buttons. So talk to your investment advisor representative. And Jenny, at the end, are we going to give our friends a chance to raise their hands and say they want to meet with us?
Yeah, we're actually going to ask a poll here in a second that asks for that. Go ahead. Sorry.
Go ahead. So before we do that, can I tease people with something that I think they might be excited about? I mean, we're talking about investing here.
Yes.
What about trading? Do we do anything related to trading in any of these investment programs?
Yeah, well, let's just clarify that. Amped Pro or Amped AIM is long-term investing funds, like your retirement funds. That's going to be long-term investing. We also have what is called the Ultra Portfolio or Amped Up. And of course, if you know Ben at all, you know he loves puns. So
yes, I actually. So the Ultra Portfolio, the Up Portfolio, right? We're pretty excited about it. Some might say we're amped up about it. Sorry, I just couldn't resist. I love it. But it's really about how we as traders can begin to take that trading money and help you with it. Maybe you're not able to be active in the trading environment. What if you could put a portion of your funds into the Ultra Portfolio? We suggest no more than 20% of your net worth to be in this program. In fact, when we have our meeting with you, we will talk all about that. This is for that 20% money. This is aggressive, highly aggressive. We don't want you putting too much of your assets into this basket. But what we're going to do is we're going to trade ETFs and specific stocks and anything else that we're going to be doing in there, Jenny?
Yes, we're actually able to do option strategies. So we can buy calls, we can buy puts, we can do credit and debit spreads and some just very advanced type of option strategies. So it's a very exciting opportunity that we're able to offer now through the Ultra Portfolio.
And I just saw an iron condor go in the other day, and we managed that iron condor in a very interesting way just today. So very active account. Jenny, Jared, myself are actively involved in this part of the portfolio. And this is something that is fairly new. And if you're already an amped client and you're not in the Ultra portfolio, why don't you get in touch with your investment advisor representative and let's have a conversation about what that can look like for you. All right. Well, as we are close to the end here, I really want to make sure you understand what we're trying to do is partner with you. And it's about partnering with you about long-term investing. And we want to use the Bible to help create the programs that are sound and safer to preserve your assets. Click button simple because it needs to be that. And I'm telling you, it is pretty simple for you to be able to engage in our program. We can help you do it, or we can do it for you. And the choice is going to be yours. You can do the work yourself. We'll teach you how, or we can do the work for you. And all you have to do, why don't you go ahead and launch poll number 2 for me, if you would, Jenny. Poll number 2 is how you can take action today on this webinar. And if you click the button and let us know approximately what you're thinking about might be your investment into the AMPed program, what's going to happen is that you're going to get an email from, who are they going to get an email from, Jenny?
They're going to get an email from an IAR, one of us, with a scheduling link in it, so that you can actually look at our calendars and see what date and time that works best for your schedule. So you should be getting an email from one of us in the next day or so, and you'll be able to schedule with us.
So here's how this works. I know you have a busy life, but you probably have a lot of really specific questions. Have you been on this webinar and you're like, I have some really, for me, specific questions that I need to ask of an investment advisory representative? Well, that's what this is an offer to do. Let us know how we can help you. We'll schedule a call. We'll give you the opportunity to do it on your time. And that's really the power of what it is that we're trying to do right now. Trying to expose you to the fact that this market is dangerous. There are opportunities to do things differently when you have people with the skill sets willing to be your partners. If you'd like to partner with us, all it takes is a click of the mouse to find out more. It's a free call. It's a free opportunity for you to spend time with an investment advisor talking about your specific situation. It's invaluable to get some perspective from somebody who's helped hundreds and hundreds of people with their situations. Let us help you as well. Well, let me close by saying, if this is a recording that you're watching, you can take action too. Right? All you got to do is go to TRADEway.com/amped, TRADEway.com/AMPT, or send an email to amped@TRADEway.com, and we can help schedule an appointment with you as well. And if you were here live, can I just say thank you? Seriously, you spent a lot of time with us tonight, getting educated on how retirement programs work and hearing how we can help you. Thank you for your investment in time. We sincerely appreciate you being here. And on behalf of TRADEway, thanks for letting us be a part of your investing journey. All right. Thanks, guys, for being on. We'll see you soon.
Thank you, everyone. Have a great weekend.
Thank you.